Welcome to the Deep Dive, your shortcut to being truly well-informed. We're kicking things off today with something interesting, a real market paradox.
hmm
On one hand, you look around, you see major stock indices just hitting new highs, day after day seems like.
Feels relentless, doesn't it?
Exactly. But what if I told you there's something, well, pretty significant shifting just under the surface?
That's precisely it. And that's what we want to explore today, that underlying data.
Right.
We're going to dive deep into market breadth.
Right.
And we'll try to uncover what signals might be pointing towards, well, what some folks are calling a healthy cool-off period.
Right.
Or maybe even a summertime pullback.
So our mission today really is to unpack these signals. They seem kind of conflicting, don't they? We want to help you understand what they actually mean for the market and, more importantly, for your portfolio.
And we're digging into insights from a recent piece by Lucas Downey over at moneyflows.com. It's titled Market Breadth is Deteriorating, dated July 31st, 2025.
Yeah, it's been quite a year already. 2025 has shown us anything is possible, right? We went from a market crash, it felt like, to total exuberance in, record time.
It's been whiplash-inducing for sure.
And just look at some of the successes. The S&P 500 technology sector, it jumped, 50% from the lows back on April 8th?
A huge bounce.
Huge. And you see accelerating AI investment everywhere. Plus, it's been a, pretty spectacular earnings season for a lot of companies.
Oh, yeah.
Think about Meta or Microsoft, MSFT, just powerful beats and raises.
Really strong numbers from them.
And it's not just the usual giants either. We've seen some discrete monster-winning stocks like Celestica, CLS.
Unbelievable run on that one.
Gained over 1,100% since it hit the Outlier 20 report list. The last few months have been one of the best stock-picking environments in years, arguably.
And that, right there, brings us to the crucial but.
There's always a but.
Always. As exciting as all this growth has been, the underlying data, it really suggests this period might eventually cool down.
Okay.
And that's why paying attention to market breadth becomes so important. It's crucial for knowing what might be coming next.
So maybe just clarify for everyone market breadth. What exactly are we talking about?
Right. Good question. So market breadth, basically it tells you how widespread participation is in a rally. Is the whole market climbing together?
Mm-hmm.
Or is it just, a handful of big names dragging the indices higher while everything else lags? That's breadth.
Got it. So to really get a handle on this underlying shift, we need to talk about a key indicator mentioned in the source, the Big Money Index, or BMI.
Exactly.
What does the BMI actually measure? Why is it so critical for understanding what's going on?
So think of the BMI as a way to gauge the ultimate power law in markets, supply and demand.
Okay.
When demand outstrips supply, stocks generally go up.
Huh?
Pretty simple concept. And if you think back to April, the BMI was actually constructive, right at the market bottom.
Really? Why was that?
Because capitulation had stopped. That phase where everyone throws in the towel and sells. That intense selling pressure was gone.
Ah.
And that stopping of capitulation often comes right before these, wicked rallies.
That's fascinating, especially when you contrast it with, say, the media narrative back then.
Totally. Remember how bearish everyone seemed? All the talk about the S&P 500 death cross in mid-April?
Oh, yeah. I remember the headlines. Scary stuff.
Right. But this indicator, the BMI, it was actually signaling risk on. Go figure. It just shows how the underlying data can sometimes tell a very different story than the noise.
That's a really key distinction. So, okay, the BMI signaled risk on back in April. What's it doing now? What's its recent behavior telling us?
We'll connect to the dots here. Since April, the BMI vaulted up into overbought territory, and it stayed there for 35 days.
35 days? That sounds like a long time.
It is. It's drastically longer than the 21-day average, so quite significant. But here's the shift, the really interesting part now. The BMI has recently fallen. It's actually at its lowest level since early June.
Okay, where is it sitting now?
Currently at 80.8%. And the source describes that as being slightly in red territory.
Red territory, meaning?
Meaning it's just dipped below that overbought threshold. And this is important because, historically, volatility tends to arrive when the BMI falls out of overbought like this.
Okay, so it definitely sounds like the data is potentially shifting, like you said. What's driving that change? What's the main factor?
It really boils down to outflows picking up.
Outflows. Money leaving stocks.
Exactly. And the data is pretty stark. Get this. Yesterday saw the most outflows since the April market bottom.
Wow. Since April. That's significant.
It is. Specifically, Wednesday clocked 106 inflows, so money coming in, but 88 outflows. So money going out. That's a noticeable shift in the balance.
Can you give us maybe some examples just to help visualize these flows? What kind of stocks are we talking about?
Sure. So the source uses something called a MAP score to visualize this.
Mm.
It sort of ranks buying and selling pressure.
Right.
And they pointed to a couple of examples recently seeing lower scores, indicating selling pressure. Dow Inc., the ticker's DOW,
Yeah.
and Novo Nordisk, NVO.
Mm.
And they noted that Dow, DOW, has actually been sold pretty hard all year.
Mm.
So it continues that trend. The advice here, really simple but powerful, follow the flows.
Follow the flows. Makes sense. So let's connect this back to, our portfolios. Why does a fall from that overbought status on the BMI tend to signal equity weakness, at least near term? What's the so what for us as investors?
Yeah, this is the key takeaway, right? A falling BMI basically tells you that inflows, the buying pressure, are slowing down, and outflows, the selling pressure, are growing.
Okay.
And that combination is often what it takes for the market to have a healthy cool-off period.
Roll back.
Exactly. And history backs this up. When you plot index returns after the BMI leaves that overbought zone, well, both large and small caps tend to fall.
Oh, really? Are there averages on that?
Yeah, there are. 2 months after the BMI exits that red zone, the S&P 500 falls on average about 1.9%, and the S&P Smart Cap 600, it falls even more, about 4% on average.
Okay. 1.9% for large caps, 4% for small caps. That's definitely something to be aware of. But, you're not saying this is the end of the world for the market, are you?
Oh, absolutely not. Not at all.
So what kind of opportunity could this actually present? Is there an upside here?
Definitely. What's fascinating is that this kind of shift, this pullback potential, often offers a great opportunity, an opportunity to buy quality names on dips.
Right. Buy the dip.
Exactly. And think about the timing, too.
Yeah.
August and September, they tend to be seasonally weaker months for the market anyway.
That's true. The summer doldrums often lead into a weaker fall period initially.
Right, so this potential pullback aligns pretty well with that historical seasonality, which could set up some interesting buying opportunities down the line.
Okay, so pulling all this together, we have deteriorating breadth, a falling BMI, rising outflows, seasonal weakness potentially ahead. How should you, the listener, play it? What are some actionable strategies based on this info?
Okay, so the source lays out 3 key recommendations. Pretty straightforward. First,
Yep.
follow the BMI. Keep a close eye on it.
Right. If it really starts heading lower, well, you'll know that more stocks are under distribution, under selling pressure.
Okay, number 1, watch the BMI. What's 2?
Second, focus on where the outflows are hitting hardest. Try to identify which sectors or types of stocks are bearing the brunt. Is it small caps taking the hit? Is it healthcare? Maybe energy stocks? Knowing where the pain is can be informative.
Pinpoint the weakness.
Got it.
And the third recommendation.
Third, start getting your buy list ready now.
Be prepared.
Exactly. The idea is, once the tide goes out, if we do get that pullback, you don't want to be scrambling. You want to be armed with your list of, all-star stocks you'd love to own at better prices. Be ready to capitalize.
Follow the BMI, watch the outflows, get your buy list ready. Makes a lot of sense. This has been really insightful, kind of digging beneath the surface of those headline numbers.
Mm-hmm. The core idea, it seems, is that even when the major indices look fantastic, soaring high, looking deeper at things like market breadth, at indicators like the big money index, well, that can give you crucial clues about potential shifts ahead.
Couldn't have said it better.
And while, yes, market breadth is deteriorating, as the source says, that doesn't have to be a purely negative thing. As you said, for prepared investors, it can actually be turned into a real opportunity.
Absolutely. And maybe that leaves us with a final thought for you to mull over. A provocative one, perhaps.
Okay, let's hear it.
If this deteriorating market breadth really does signal a healthy cool-off period, what kind of unexpected opportunities might pop up, specifically in those sectors that see the deepest tide going out? And, how might that redefine what buying the dip actually means in this pretty unique market cycle we're in?
What hidden gems might surface when the tide pulls back? Interesting. Definitely something powerful to consider as you navigate the market in the coming months.